Welcome in, everyone, to another episode of the Real Estate Tax Playbook, where we discuss all things real estate, providing timely and precise tax information to real estate professionals looking to build their own customized tax planning playbook. As always, I'm your host, Evan Ross, Tax Director with Brown Edwards & Company, based out of our Roanoke, Virginia office location. I'm sure by now most of you have had a chance to check out Brown Edwards' website, but if you have not, please go check that out at your convenience. A link to our website can be found in the description of this podcast. On the website, you'll find more information on our service lines, as well as our other service providers and our office locations. With all that, I'd like to introduce our guest for today's episode. We have Rich Hedley, tax partner with Brown Edwards & Company, also based out of our Roanoke, Virginia office. Rich, thanks for being here today.
Thanks for having me, Evan. How are you?
Yep. Very good. I appreciate, I'd like to say it's been a while, but we just saw each other yesterday.
Yeah.
So anyways, well, I appreciate you coming on. I'd like to give you a chance before we get into it, just kind of provide some information on yourself, what you do for Brown Edwards, a little bit of background.
Yeah, sure. I thought you were going to talk about football, but you know.
Oh no, we're gonna get into that. Don't you worry.
Yeah. For your viewers, my name is Rich Hedley. I am the state and local tax leader for Brown Edwards. I've been with Brown Edwards now for 6 years, and actually, my 6-year anniversary will actually be June 1. So, a couple days from now.
I know, right? All right. It's crazy. It's already been 6 years.
Yeah, I know. It's also my 26th year in public accounting. So, you know, time flies when you're having fun. I guess it also ages me, right?
Hey, maybe a little bit. I'm just so everyone knows out there, I'm not near 26 years, so I've still got a little bit of time to catch up to you.
Yeah.
So, awesome.
Yeah,
well,
thanks for that.
Of course. Well, again, hey, I appreciate you coming on. You mentioned NFL, so why don't we just talk about that for a minute? I usually try and have a quick segment. I'm trying to come up with a witty name. I've thrown out "Tell Me More" as the segment, so we'll see if that sticks. But obviously, you've got a Tom Brady photo behind you. I know you're a big Tampa Bay Buccaneers fan. So, what's your outlook on the season this year?
You know, Tampa is in a pretty weak division, so you know, the NFC South is not the best division in football for sure. So my expectation is that they'll win the division again, I think. So Atlanta might be their biggest challenge, but I think we can handle Atlanta.
Yeah. Well, maybe that just means it's a competitive division. You never know. That's what I always say about. I'm a Steelers fan, so I always say that about the AFC North. That
well, I know the audience there might be a lot of Carolina Panther fans in the audience just because of proximity, but they're an up and coming team, so you know.
They've got a lot of young talent, so you never know what's gonna happen. So
I was going to stole the Bucs offensive coordinator a couple of years ago, so you know.
Yes, yeah, sure. They're maybe a little bitter about that, maybe. So, anywho, I wanted to mention too. They had the NFL owners meeting up in Minnesota recently. They had talked about a bunch of rule changes. One of them was playoff seeding. And I just wanted to get your thoughts on it, where division winners didn't necessarily get a home game. The seeding was going to be based on record, and the Bucs, for instance, would have been a 6 seed given this new format instead of a 3 seed with a home game. So, what are your thoughts on that?
Well, it didn't pass, so
it didn't.
I think my thoughts on that are the same as what the owners' thoughts were. I think if you win the division, you still should get home field, regardless of record. You know, it didn't matter much. Washington still beat Tampa Bay at that home game, so it didn't really matter much.
Yeah, didn't matter. So I'm kind of in the same boat. I agree with it. I think there's a reason they have divisions and a reason there's you get something for winning that division. So
maybe they need to reshuffle the divisions. I don't know.
Yeah. I guess maybe that's a topic for another day.
Exactly.
Anyways, well, cool. I appreciate that. Now let's kind of get into the meat of the conversation. You mentioned you were the SALT leader for Brown Edwards. So you hear Nexus thrown out there a lot. Can you just kind of briefly discuss Nexus, what that is, what that means, and kind of just the general landscape of state and local tax right now?
Sure, Nexus can be a pretty nebulous topic, I guess, for a lot of people. I actually think it's kind of nebulous for some of the states out there too, because different states have different laws governing Nexus.
Hmm.
Um, so, but in the basics of it is it's a connection between the taxpayer and the taxing jurisdiction, the state. And there must be sufficient enough connection with the state for that state to impose the tax. And really, that's kind of the key phrase is what is sufficient enough to impose a tax. And that's where states have differing laws that govern what those connections that are sufficient enough to create nexus. So that's where you really need to have a good tax advisor to advising you as to what states that you could be operating in that could create nexus for you. Um, and from a real estate perspective, and when I talk about real estate, primarily rental real estate perspective, physical presence is really what it's all about, and that's people and property. And from a rental real estate perspective, we're talking about property, so that means the state where the rental property is located will be the state that taxes that property.
Yep. Fortunately for our listeners, I think the Nexus is relatively straightforward. If you have property in a state that you own, it's going to create Nexus, and there is going to be a income tax filing requirement in that state if they have an income tax.
Yeah, and physical presence will always create nexus for you.
Yep.
There isn't a state out there that doesn't say that physical presence doesn't create nexus.
Yep.
Where nexus really gets to be nebulous is with other businesses like manufacturing and retail businesses that are effectively shipping products to other states and generating sales from those other states without having a physical presence. That's where it really, really gets nebulous for businesses like that.
Okay. Yeah, and you mentioned manufacturers, things of that nature, where they're shipping stuff. A lot of those do also own real estate, so there is a component there. I will throw out for those of you, if you go check out the Brown Edwards website, we do offer Nexus studies as a service that we can provide. Rich, can you kind of provide some additional information on what a Nexus study looks like when it's a good opportunity to look at one?
Yeah, a nexus study would be a good thing to do if you're a business that is in multiple states and where sales are generated in those states via some kind either via delivering a product into that state, or you have clients in which you are servicing them from different locations into different states. Um, a Nexus study will help to identify what states you potentially don't need to file in and what states that you possibly do need to file in. Not having a Nexus study may make that business actually file in more states than they need to, or not enough states. So you certainly don't want to file in more states than you need to file in. So I would certainly a Nexus study, and it doesn't have to be necessarily a full-blown Nexus study. At least some kind of a Nexus analysis for a business would be very much recommended.
Okay, great. Yeah, it's good to know that there are options. It doesn't have to be that full-blown Nexus study, that there are other options. So that's great. I appreciate that piece. There's probably a lot of our listeners out here that are at this point, they're kind of like, well, I think I might not be in compliance. Can you kind of discuss VDAs, voluntary disclosure agreements, what those are, and how that process works?
Yeah, voluntary disclosure agreements are great because what the listeners need to understand is if you never file a tax return, there is no statute of limitations. Okay, that means that a state if you've been, have business in a particular state and you've never filed a tax return there, and it's been like 20 years or 10 years, let's be more realistic, it's been 10 years, that state could theoretically go back 10 years and assess tax, penalties, and interest on the business for a 10-year period. So what voluntary disclosure agreements do, they allow a business to come in. Initially, it's anonymous, where you just effectively write up the facts and circumstances of your situation. And every state is different, like, just like their tax laws. Every state has a different way of coming in anonymously and telling your story, either through some kind of an online application or by just writing a letter. And you anonymously tell the facts, and you provide them how you want to effectively pay that tax to them. And then they either say yay or nay to the voluntary disclosure agreement. And then if they say yes, then you effectively announce yourself, you tell who you are, and then you file past tax returns and pay the tax associated with those tax years. The good thing is it limits, typically the states limit how far back they can go in tax to either 3 or 4 years. So the maximum they would go back is 4 years. And then they would also, most states, not all, but most states will abate all penalties associated with it. So effectively what you would be doing is just paying the tax plus some interest related to how far back it goes.
Yeah. Yeah. So that's a great option because, like you mentioned, you're probably going to avoid the penalties, and they're capping it at 3-4 years, depending on the state. Could be different instead of that 10 years in your example that you mentioned. So
That's right.
that's definitely a great opportunity. Have you seen that with being successful with physical presence non-compliance, or do you typically see it more with economic nexus?
When you're talking about the disclosure agreement?
The disclosure, yeah. So if you had property in a state, hadn't been filing for one reason or another, didn't realize you had to file in North Carolina, and you were in
No,
Virginia.
it works. So the only way it wouldn't work is if the state has already contacted you. Okay.
Okay.
So if the state, and when you have physical presence, it's more likely that they will contact you. It's the economic nexus or the factor presence nexus is where they may or may not contact you because they don't necessarily know you're there. So it's more likely if you have physical presence that they will contact you. So it's important to do these voluntary disclosure agreements just as soon as you know that you have nexus in those states.
Great. Well, thanks for clarifying that. So if anyone has additional questions on that, please feel free to reach out to Rich. We can definitely assist with that. Let's continue on with relating this to real estate. So the Tax Cuts and Jobs Act, TCJA, back in 2018, they decreased the SALT cap down to $10,000 for federal tax purposes. Can you discuss PTET, PTET, pass-through entity tax, and how that has kind of alleviated that SALT cap reduction? Every state's different, but Virginia, obviously, 2021 is when they started. So can you just kind of talk on that?
Yeah, like you said, the Tax Cuts and Jobs Act is the one that limited state and local tax deductibility, and this is effectively for all pass-through entities like partnerships and S corporations, and that's primarily because as most of the business owners out there that have pass-through entities know, their income from that business is taxed at the individual income tax on the individual income tax return, and therefore the state taxes that are paid by the business are treated as shareholder or partner distributions to those shareholders, and they deduct those state taxes on their Schedule A of their 1040, and that's where that $10,000 limitation comes into play. So like you alluded to, many states did create what's called a workaround for that limitation. And yeah, quite frankly, Connecticut was the first one to do it, and they did it back in 2018. And
Oh, wow.
they actually made it mandatory to do it. But they have since made it elective, like most states. And you alluded Virginia created the option in 2021. Um, so what they did is this workaround is the pass-through entity tax, or PTET or PTET, however you want to term it. The IRS blessed it with a notice, an IRS notice. They blessed the treatment. They said you can do it, although they didn't really give us much guidance related to it, on how to treat the deduction. But there's a lot of literature out there that CPAs have opined on about how it should be treated, and if it's from an ordinary business that has ordinary income, then it would be an ordinary deduction.
Yep.
And the state allows you. The basics really are the state allows you to elect into this regime. You don't have to do it. It's elective. Like I said, Connecticut did make it mandatory, but they have since changed that and made it elective into this pass-through entity regime, which effectively, what most states do is you just check a box. This is what I want to do when you actually file the tax return, or you make estimated tax payments throughout the year. But with any state tax law, there's a lot of different varying degrees of how to elect this regime. So you should contact us or your tax advisor if you have any questions about how to elect this. But effectively, once this election is made, state taxes incurred that are attributable to the business would now be deductible by that business, which effectively creates a lower federal taxable income that is passed through to the owners of the company on Schedule K1. So, for example, if $100,000 is what was passed out to an owner that's 100% owner of a pass-through entity, if he had a $10,000 state tax that was paid and he didn't elect it, it would be the $100,000 that's passed out to him, and then that $10,000 would get deducted on the Schedule A if he could deduct it. But if they did elect it, that $100,000 that got passed out originally would now become $90,000, because the business was able to deduct it at the business level.
Great. Yeah. Well, thanks for clarifying that. So obviously making this PTET election makes sense in a lot of scenarios because it is creating a an additional federal tax savings that otherwise you're not going to get with that $10,000 cap currently.
Right.
I will go straight in, I guess, related to that. Just passed the House, but the one big beautiful bill. They need to come up with an acronym or an easier way to say that. TCJA kind of rolls off the tongue.
It's It's OBBA.
Yeah.
Right?
Yeah, OBB. Yep. Yep. I don't think it rolls off the tongue as good as TCJA. Yeah, I was listening to a webinar I think yesterday, and they used the OBBA. So we'll get used to it, I guess. But anywho, they talked about increasing the SALT cap. There's still a ways to go. Still got to get through the Senate and see what happens. This episode's going to air in July, so I don't think anything's going to happen before then. But what are your thoughts? Do you think that SALT cap is going to increase, be eliminated? What are your thoughts on it?
Wow, that's a
kind of a loaded question. But...
kind of a loaded question. Yeah. If you look at, I think we're sending out an announcement tomorrow about it to our clients, and you'll see the vote. The House vote was 215 to 214, so it didn't pass by much.
No.
And you've already heard senators come out, and even Republican senators that say that they won't support the bill in its original form. So there could be a lot of changes to this bill. Now, that being said, I'm not sure that they'll change this part of the bill. I think that $40,000 limitation, if anything, maybe they'll reduce it to $30,000. I still think that there will be an increase from the $10,000 limitation to, $20,000, $30,000, or it will stay at the $40,000. I would not anticipate them changing that by too much.
Okay. Very good. I appreciate that insight. Again, like I said, this is all speculation because we don't know what the Senate's going to do and what that final bill is going to look like. But I guess it's probably safe to say that there will be some type of increase in the salt cap. We just don't know what that exact amount is at this point in time. So, all right. Well, moving right along, I want to mention a lot of our investors out there, developers, there's development involved. So they're purchasing a property. There's months, 18 months of construction, renovations, things of that nature. They're going to incur some costs like property taxes until that property is placed in service. Are those property taxes, is that something they can expense? Does that need to be capitalized as part of the building? How does that work?
Uh, there's elections that could be made that would make it part of the building. But property taxes typically can be deductible.
Okay.
Yeah.
Very good. Thanks for.
And that goes into record keeping, I think, and the importance of record keeping and tracking things by state. Really, it's more tracking things by property, because IRS wants you to, if you're in the rental real estate business, IRS wants you to track everything by property, which inherently means that you can track it by state if the property is in different states.
Yep. And that kind of ties back into Nexus, which we talked about earlier. You do need to have proper records. If you've got 12 properties and 10 are in Virginia, 12 are in North Carolina, you need to be breaking that out by 12 separate activities, all the profit and loss, any expenses, any construction, purchases, all that stuff needs to be tracked separately for IRS and tax reporting.
Right.
So
exactly.
It just goes back to making sure that you do have proper records, that you are either doing it yourself, have a property management company, or involving your CPA in that record keeping process.
Yeah, certainly it's pretty straightforward if all your properties are in the same state. But yeah, it gets a little trickier when they are in multiple states.
Yep. Yeah, you definitely don't want to be lumping all of that activity together as one activity.
Right.
So very good. Another thing I do want to mention is depreciation. That's a significant item for a lot of our listeners out there. We talked about cost segregation studies in the first episode of this podcast series. I want to circle back to that as far as state implications. So everybody hears that bonus depreciation it's 40% this year. It may go to 100% with this one big beautiful bill. How do states look at that? Do they conform? Do they have different rules? We don't need to go through each state, but just talk on that a little bit.
Yeah. Yeah, some states conform and some states don't conform. So, it goes back to what I alluded to earlier about state laws being different. So I'll take Virginia, since we're here in Virginia. Virginia conforms to 179 deduction. Now, whether or not, I believe they are increasing the 179 deduction pretty significantly in this bill that's being proposed. So whether or not Virginia conforms to that is yet to be determined. But currently, they conform to 179 expensing.
Yeah. And 179 is already pretty high in itself as it stands,
right.
the
annual
limit.
Exactly. So, but whether or not they're going to increase it to what this bill proposes, who knows? Yeah. But one thing that they do not conform with is bonus depreciation. And this bill is bringing back 100% bonus depreciation, and Virginia will not conform to bonus depreciation unless somehow they change it between now and when this bill gets passed. But currently they do not conform to bonus depreciation. So all states typically start with federal taxable income or federal adjusted gross income, and they make adjustments based on their state tax law, either a subtraction or an addition to that federal income to get to their state taxable income to apply their state tax rate.
Okay. Yeah, thanks for clarifying that. We don't need to go state by state, but just be aware, listeners out there, just be aware that all states don't necessarily conform to when you hear this one big beautiful bill or other things out there, but from a federal level, that doesn't necessarily apply at the state level. And even after this bill passes, as you kind of alluded to, states are going to make the determination if they're going to conform to everything that's passed.
And I'll give you one more example, like North Carolina, since it's a neighboring state.
Yep.
North Carolina does not conform to either 179 or bonus depreciation, and they have a nice, strange calculation that's a lot different than Virginia.
They do. We won't get into that calculation
No.
today, but it is definitely a little more cumbersome than Virginia's just, hey, we disallow it and you've got to do it over the 5-year period or 10-year period or whatever property asset live you
Right.
have. So, all right. Well, thanks for clarifying that on depreciation. Is there anything else you want to add to this conversation about state and local taxes? Anything that would be important for listeners out there?
Well, a lot of times what I hear from clients or prospective clients is, why do I want to do a Nexus study where I would have to file in more states than, just Virginia? Let's take that as an example. And because they don't want to pay more tax. And what I would always say to them or try to point out to them is that filing in more states does not necessarily always mean that you're going to pay more overall tax. What our job is and what we do is to help to ensure businesses are paying their overall taxes to the correct states. Okay, because think about it, your resident state, if it happens to be Virginia, will allow a tax credit for taxes paid to those other states. Okay, now it might not be a one-for-one, dollar-for-dollar, particularly if a state has a higher tax rate. But if they have a lower tax rate, you're going to get a full credit for the taxes paid. For instance, if you have properties in both Virginia and North Carolina, and you're paying North Carolina for the properties that are in North Carolina, North Carolina's tax rate is lower than Virginia's tax rate, okay? So you're going to get a full credit for any taxes that you pay to North Carolina in Virginia. So you're not necessarily paying more in taxes, you're just filing in the right states and paying the taxes to the right taxing authorities. So that's the thing that I try to get across to a lot of people, because when they think about more states, they think about more tax, and that's not always the case.
Yeah. Thanks for clarifying that, because I do think people just kind of gravitate to, like you said, more states means more tax, means more money out of their pocket, which isn't necessarily the case. You and I were actually doing with one of my clients recently where they had Nexus in North Carolina, had a North Carolina filing requirement, and we're getting that Virginia credit for the taxes paid to North Carolina. So there's definitely more conversations to have in that area. So very good. Well, I appreciate you coming on. I know you've got a vacation you got to get to, so I don't want to hold you too long.
Well, you
today,
just got
but,
back from vacation, so
I did just get back from vacation, so I'm not going anywhere anytime soon. So you earned it, and you should have some fun with it. But before I let you go, can you just provide your contact information if people do have additional follow-up questions on Nexus, VDAs, anything related to state and local tax?
yeah, Richard Hedley is my name. My email address is probably the best way to get a hold of me, and that's RHEDLEY@BECPAS.com.
Awesome. Thank you very much. Again, I appreciate you coming on. That is a wrap for this episode of the Real Estate Tax Playbook. As always, I appreciate our listeners. Please make sure you subscribe wherever you get your podcast and continue to tune in the months to come. Got more good content out there. So take care.